Alibaba just reported their Q1 fiscal year 2023 results, and you guys already saw that I released a first look, but you guys know that I always follow it up with a 3-part deep dive, and so this is part 1. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And you guys saw that this was actually an interesting quarter. I don't think it was a good quarter. I don't think it was a bad quarter. I actually expected a bit of a mess, and that's why I didn't actually release a preview this quarter, because I didn't know how those lockdowns would actually impact Alibaba. And we did see that those lockdowns did actually impact China commerce a lot more than what sort of the surface numbers sort of shown. And I'm actually going to dig into that and show you exactly what I mean. So let's dive right into this. And what I wanted to show is that in this video, in part 1, I'm going to cover China and their international commerce. Now, if you just combine China and their international business, that makes up approximately 80% of the overall revenue for the company and virtually all of their cash flow. And so this video, the first one, is the most important one. And so in the second video, I'll cover all of the other segments. I'll spend a lot of time on cloud and their local consumer services. And then in the third video, I'm going to provide to you guys a new valuation, a new model that I'm going to walk through. I'm also going to cover the options chain for this, because a lot of comments I get every month about people wanting me to cover cash secured puts a little bit more and sort of talking about how I think about them. And so I will do that in part 3. Now, in order to understand the China commerce business, you have to break out the consolidated totals for the segment to understand exactly what's going on. And so I've done that here. Well, management's actually done that for you. But beside those names that they provide you, customer management, direct sales, and China commerce wholesale, we kind of really don't know what any of that means. And so beside it, I put exactly what the brands are. So customer management is Taobao, Tmall. Direct sales is Fresh Hippo and Sun Art. So those are their grocery stores. And then China commerce wholesale is Taobao Deals and Taocaicai. Now, I might actually be mistaken with the last one there. They might actually be including Taobao Deals and Taocaicai into customer management, but I actually don't think they're doing that. I think they've broken it out. But overall, the story here is that wholesale is doing fantastic, direct sales is doing well, and it looks like Taobao and Tmall had temporary setbacks, which could reverse in Q3. Let me explain. Now notice, this is their commentary breakout of their China commerce retail segment, and they said that it went backwards by revenue by 10% year over year, primarily because of increased order cancellations due to impacts from COVID-19's resurgence and restrictions that were placed on the supply chain and logistics disruptions in April and May. And so effectively what's happening here is that part of the decline in the quarter was due to the slowdown in economic activity, but it looks like part of the decline was also due to the fact that customers couldn't actually gain access to products due to the COVID lockdowns that they're continuing to do in China. And so that of course would impact the supply chain, which will result in canceled orders. And so this could actually potentially result in a catch-up surge in orders in second quarter of 2023. I don't know if that's actually going to happen, but that's kind of the way I'm thinking about it. There's some orders that consumers will probably go without, but there's some orders that would just get delayed into Q2 of fiscal year 2023. So I could see a surge here. I could also see a second level surge, sort of like a second order impact, if the CCP goes ahead with giving the consumers some coupons for them to use for online purchases. I don't know if they actually end up doing that. There was some muttering that that would happen, but there's nothing really official that has been said from that perspective. Now, going into their direct sales, they tell you that their direct sales increased 8%, primarily due to revenue growth contributed by Fresh Hippo and their Alibaba Health direct sales business. And so overall, this business is doing great. Very few companies can compete with Baba here, and it's not in the eye of the CCP. I just don't think that the CCP is going after this business. We haven't heard any inkling that the CCP is going after the grocery business or the online grocery space. And so I just think it's free and clear. And I expect to see continued great results in the direct sales category. Now, I know you guys want me to go into more detail into the Fresh Hippo business. The truth is, there just hasn't been more information that's been put out. And so the best detail that I can give you on the Fresh Hippo business is stuff I've already covered in the Alibaba Investor Day. And so I will link to the Investor Day series at the end of this video. But overall, all I can say for now is that the Fresh Hippo business and the direct sales business as a whole is doing okay. Now, moving into the China wholesale revenue business, notice that this business went up 26%, which is primarily due to an increase in revenue from new duty-free wholesale businesses and value-added services to paying members. And so I think that the explanation is a little bit vague here, and it's something that I would like to dig further into, but at the moment it's nice to see that this segment is growing out fast. Jumping into the Ebitda, notice that the Ebitda actually declined by 14%, despite the fact that customer management only declined by 10%. And the reason for that is because all of the other segments are not cash flow positive just yet. So what that means is that Taobao and Tmall losing revenue is tough because they are heavy Ebitda generators. But the one thing that I do want to note is how Taobao deals and Taocaicai are beginning to narrow their losses and become profitable. So that's very exciting, because if you have additional cash flow generators in that wholesale business and that direct-to-consumer business, Alibaba becomes exponentially more valuable. And so that's the direction that this business is going, and we're seeing it happen. And this is my main thesis for why I've purchased Alibaba. I do not believe that Alibaba's total revenues will pivot significantly from this overall segment of China commerce and international. Right now it's around 80% of the business, and I think even 10 years out it might only come down to around 75% of the overall business. But this is the main thesis. Everything else is noise in my opinion, including cloud. Now let's dive into the international commerce segment. Now before we go into that, I just want to remind you what the international commerce segment is. You got AliExpress, which is global for individual products. You have Lazada, which covers the Southeast Asia market. You have Trendyol, which covers the Turkey market. You have Duraz, which covers Pakistan, and then you have Alibaba.com, which is a global wholesale brand. And notice that there's two separate narratives happening in the international segment. International commerce retail has gone backwards, and international commerce wholesale surged by growing 12% year over year. So what exactly is happening? So let's start with the segment that's gone backwards a bit. And so overall, the story is really the same here that we've heard over the past couple of quarters. There's weakness in Europe from their new tax rule, that value-added tax rule, the ongoing conflict, which is causing weakness in Europe, and the currency is weaker, and so currency translation adjustments would make the international commerce retail revenues look weaker. Now, this is offset in part by continued strength with Lazada in Southeast Asia. What they didn't mention here, and I think they mentioned a little bit later, is that Trendyol and Duraz are likely also weak in light of economic weakness both in Turkey and Pakistan at the moment. So that's something that we have to continue to watch, but overall, Duraz and Trendyol are not major components of this segment. And now with wholesale, you can see that the increase was primarily due to revenue generated by cross-border related value-added services. And so I really love this, because this is a good news story emerging here as Alibaba is focusing more on offering value-added services, which of course helped Lazada as well, and it looks like it's helping here as well. So more of this. That's really what I want to see. Now moving into the adjusted EBITDA for the international business. As predicted in the deep dives from the previous quarters, we were expecting weakness in Turkey due to their currency crisis, and despite Alibaba reporting strong results in the business back then, we're now starting to see those weaker results over the past couple of quarters, causing a drag onto the EBITDA. But those losses are actually being reduced by Lazada, as Lazada is becoming more profitable as a result of increased revenue and enhanced operational efficiency. And so that's really good to see, because we want to see Alibaba succeed in markets that are outside of China. Now, I do have to admit that I didn't believe in Alibaba's capability to compete against Sea Limited in Southeast Asia, but it looks like they're doing well. And so let's see how this plays out into the future. Now, I do want to share something special with you guys. I did say that I was going to walk through the new model that is available to all the Patreons in the third video, but I just wanted to show you what that model looks like. So you can see here, this is how I'm forecasting China commerce. Well, taking a step back, notice how the model is extremely granular in detail. This is the deepest level of detail that they provide us. So I've broken out China commerce, I've broken out international commerce, and then you see those other segments that tie out to the total revenue. Now notice that for China commerce, I'm actually forecasting that revenue declines in this year. And for China commerce wholesale, I'm also doing the same thing. For their international business, I'm saying that it kind of flatlines, it doesn't go anywhere. And then, of course, in the subsequent years, I believe that it grows by 10% thereafter. So the 0% for international might be a little bit on the light side. And of course, the negative 7.5% will probably also be on the conservative side for total China commerce in fiscal year 2023. But there are risks, so I'm sort of hedging for that. In 2024 and beyond, I think 2024, 10% might be a little bit high, but definitely as you go further out in this model, that 10% growth might be a little bit low. So you can see that there's a lot of conservatism built into this model, which may not actually reflect how people are viewing the future growth of this business. But the question is, what does this conservative model give us in terms of valuation? Well, you can see here that the valuation comes in at around $294 per share, or effectively $300 per share, which is what I've been quoting for a long time. And so I'm getting to that $300 per share valuation doing two things. One, I have a terminal multiple of 20 times earnings, which once again, I think is a little bit low. And the second thing is in their excess cash, I'm not including their equity investments. And the reason why I'm not including the equity investments is because I'm forecasting out the earnings for those equity investments and taking that into my evaluation. So I don't want to double count by including those earnings, but also including the equity investments as excess capital on the balance sheet. So that's why it's excluded. Now here's something very special for you guys. A lot of you guys have been mentioning that their stock-based compensation as a percentage of free cash flow is very high. So how do you address that? And I haven't really seen any YouTubers really talk about that. The Patreons know how we cover it. We actually do this for many of the companies on the tracker that have this issue. And so I want to show you how I'm covering it. You can see here that I forecast what stock-based compensation as a percentage of the free cash flow is expected to be, and I reduce the forecasted free cash flow for that amount. So I'm forecasting that even into 2032, that stock-based compensation as a percentage of free cash flow is expected to be 25%. Now, in the early years, that might be appropriate, but in the later years, that it might actually be a little bit too high. And so the model might be actually a bit too conservative in that perspective. You might want to forecast that declining down to 15 or 20%. And that, of course, would give you a higher intrinsic value for the stock. But we're already valuing it at $300 per share. It's only trading in the 90s. So no matter what you get to, whether you get to 300 or you get to 500, it's undervalued in my perspective. Now, that's not investment advice. It never is. Always talk to your investment advisor, but I love to do the work. I love to value out these companies and see what they're worth. And I'm a shareholder in Alibaba. Now, if you want access to that brand new granular detailed model, you can get access to that at the lower tier of the Patreons. And if you want to join us for a live epic presentation each month, which my very best work is reserved for, you can join us at the upper tier of the Patreon. Now, I did mention that there's a lot of good information in that Alibaba Investor Day video series that I put out. And so if you haven't seen it, you can get access to that whole series right here.